Nvidia is the most valuable company in the world. It has a market cap of more than $4 trillion. In the past 5 years, it has soared more than 1,200%. If you invested $10,000 in the stock back then, you'd be up to more than $140,000 right now. The company is still growing at a rapid pace of more than 50%. But did you know that despite the massive demand for its chips and tech companies seemingly spending endlessly on all things AI related, that the vast majority of Nvidia's business comes from just 6 customers? Although it didn't specifically name which customers are responsible for the bulk of its sales, Nvidia did note that one direct customer accounted for 23% of its total revenue last quarter, which it called customer A. Another one, customer B, accounted for another 16%. It also listed 4 other direct customers, which made up 14%, 11%, 11%, and 10% of revenue. That adds up to a whopping 85% of its sales from just 6 customers. And so why does that matter? The obvious problem is that means Nvidia is highly dependent on these big tech companies, aka hyperscalers, which are spending big money on AI chips. While Nvidia didn't name the companies who are its big customers, it's not hard to guess who they are. Think of the AI chatbot makers, the Magnificent Seven. Those are the big players that have the budget to spend on Nvidia's chips, which are expensive and allow the company to generate big margins. The danger is that if there's a slowdown in the economy and one of these big companies starts to scale back, then that could have a significant impact on Nvidia's sales growth and a ripple effect throughout the entire tech sector. Nvidia is the most valuable stock in the world, so expectations are going to be big for it to continue to perform at a high level in order for it to continue rising higher. But it's a risk nonetheless that you need to be aware of if you're buying the stock, because if one of its key customers starts to cut back, the others could too. Nvidia needs the hyperscalers, and if there's any kind of a slowdown, that could be trouble for its growth. One saving grace, however, is China. The company may be able to sell plenty of AI chips to China now that it has reached agreement with the US government where it will give them a 15% cut of sales. Nvidia's CEO also thinks there's a possibility they'll be able to sell the newer Blackwell chips there as well. And China is a big market for AI. And Jensen Huang called it a $50 billion opportunity that's growing by 50% per year. So it's possible if there is a decline in demand domestically that China could pick up the slack and keep Nvidia's growth rate high. But the problems with AI may be much bigger. Recently, an MIT study found that 95% of companies aren't seeing much of a payoff from their AI investment. That's a problem, and it could lead to companies abandoning AI projects, and that could be what triggers the hyperscalers to also cut back on spending if their customers are giving up on AI projects. For now, everyone still seems willing to spend big on AI, hoping that the payoff will come soon. But the longer it goes on without much of a clear benefit for businesses, that could hurt sales for the Palantirs of the world that are experiencing high levels of growth, which has been critical to their enormous valuations. I don't want to say it's a bubble, but it's definitely reminiscent of what happened a few years ago. Tech companies built up their capacities post-pandemic thinking demand was going to remain astronomical. Then, when that didn't happen, the job cuts and layoffs followed. Hopefully that doesn't end up happening again, but looking at all the AI hype still out there could be a lot of downside risk for many AI stocks, including Nvidia. While it may still be a good long-term buy, it can be risky getting in at these levels. So what do you think about Nvidia and other AI stocks? Are they still heading higher, or do you think we are in an AI bubble? Let me know in the comments, and please be sure to like and subscribe for more videos. Thanks so much for watching.